Hello, I'm Bernard Hickey with the Daily Briefing from interest.co.nz. Today we'll look at the latest news on farm prices, where the dairying boom is going straight into higher dairy farm values. We'll also look at the astounding rise in the gold price to over $950 an ounce, which shows investors are very worried about inflation. We'll look at what those inflation worries mean for our interest rates and exchange rate, which remains stubbornly close to 80 US cents. But firstly, we have news that dairy farm prices are racing ahead because of the higher dairy payout. Dairy farm sales volumes are also rising. Figures out on Friday from the REINZ show the median price for dairy farms sold in the 3 months to the end of January was a record $4.25 million. We've worked out the average farm price in the month of January alone was over $4.5 million. That is up from $3.58 million in the 3 months to December and is up a whopping 57% from the same period a year ago. The number of dairy farm sales is also rollicking along. There were 48 sales in January, 53 in December and 55 in November. The dairy boom is also spilling over into beef and sheep grazing farm prices. Now, beef and lamb prices are near record lows, but still, farm prices for grazing land actually rose 45% from a year ago to a median price of $1.3 million. That's because dairy farmers are either buying up sheep and beef farms to convert them to dairying, or they're buying the land for grazing dairy cattle. So what does this mean for the rest of us not lucky enough to own a farm? This boom in rural New Zealand will be watched closely by the Reserve Bank, particularly given much of it is being fueled by bank lending. It will no doubt flow into inflationary pressures in the provinces. The Reserve Bank is widely expected to keep rates on hold when it next announces its decision on March 6. But there is little room for rate cuts, given inflation is above the 1 to 3% target band. Farm prices have almost doubled in the last 2 years. That cannot be ignored by the bank. Now for some news about an asset we don't talk about much: gold. It's been somewhat unfashionable as an investment class for decades, since central banks dropped the gold standard and no longer promise to exchange banknotes for physical gold. For much of the late 1980s and 90s, the price languished as inflation fell back to the low single digits. Although in 1980, the gold price jumped to over $850 an ounce. That happened after the Iranian Revolution and just as the Iran-Iraq War was starting. Overnight, the gold price hit a record $953 an ounce. Many analysts are now saying it will go through $1,000 an ounce. What is this all about? Gold doesn't produce a natural income. It's useful as an ingredient in jewellery and some electronics such as mobile phones and computer chips, but otherwise it just sits there and it's heavy and shiny. But it is seen as some protection if the real value of paper money starts to fall. And that's what many investors are worried about now. They're worried inflation is beginning to get out of control and that central banks are simply printing too much paper and the actual purchasing power of that paper money will drop. They're thinking if all else fails, people can always change back to gold as a store of value. The last time this happened was in the late 1970s and early 1980s, when oil prices surged and triggered a period of high inflation and stagnating economic growth. It became known as stagflation. Sound familiar? Well, that's what we appear to be facing now, that American inflation has accelerated over 4%, and yet the US economy is slowing. The Wall Street Journal's lead story today was all about the threat of stagnation and stagflation. That's one way to get Wall Street traders thinking about the risks of inflation and the value of gold. So what does it mean for us? Our currency tends to strengthen along with the Australian dollar whenever commodity prices rise. That's why our exchange rate is up around 80 US cents right now. That will actually help our Reserve Bank keep inflation under control, although higher commodity prices do tend to feed through into domestic inflation eventually. Though one thing is sure, don't expect to find jewellery getting any cheaper in the next year or two. Well, I'm sure you'll still be able to buy cheap jewellery. I'm Bernard Hickey from interest.co.nz with the Daily Briefing. Catch you on Monday.